Most people overpay for stocks when they just buy shares. But what if you can get paid while waiting for the price you actually want? I've placed over 1,000 of these trades since 2018 with a 90% win rate. Today, I'll show you the full system I use to trade my 7-figure portfolio. Cash secure put selling, a repeatable income strategy. Let's talk about why we should use this strategy and the benefits. First of all, this strategy is one of the few strategies in trading that you get to collect your premium immediately. You collect the cash upfront the moment you open the trade. There's no waiting and there's no guessing. The premium is deposited in your account right away, and that is a great thing because you can even withdraw the amount right away. You can transfer that amount to another account, or even you can put another trade on using those funds. Also, with this strategy, you get to buy stocks at a discount. If you're assigned, you get to acquire the shares at a price you pre-selected, which is your strike price. And usually that is below the current market value by design. So you're buying stocks at a discount. Not to mention, you get to keep the premiums that you collected, so that will further decrease your average cost. Another benefit is passive income via Theta. Time decay works for you every single day. Your option loses value as expiration approaches, and that's money in your pocket. Every single day, the premium that you collected will be decaying through Theta decay. That's something you don't need to do and happens even over the weekends. And this is my favorite part about this strategy. There's a huge room for error. There's a huge built-in error buffer. The premium collected acts as a cushion. And on top of that, you can be wrong on the direction and still profit because your strike price will be fairly far away from the current market price. And as long as we expire above our strike price, even by a cent, you're going to be keeping the full premium that you collected up front when you first open the trade. This is a major edge over simply buying stocks. And this is not a secret strategy. Even Warren Buffett uses this strategy. In his newsletter, a shareholder newsletter, he mentioned that he collected billions in premiums when he did this strategy on the indexes. It is a disciplined, institutional grade approach available to every investor. You can be a small account and you can do this, and you can also be huge. So it's very scalable. So this strategy works for small accounts from the 4 digits all the way to the 8, 9, 10 digits. It doesn't matter. This course will be a fairly long course. It's a full masterclass. It will take about an hour to fully complete. So I have broken this course into 4 structured modules, each building on the last. And by the end, you'll have a complete, repeatable framework for generating income with put options. The first part of the course is going to be about option basics, the fundamentals, the foundations. I'm going to introduce you to this strategy. We're going to talk about the options basics and how to sell options step by step with some live examples. The second part to this course, we're going to talk about the stock and strike selection. How are we going to choose the best quality stocks? What kind of stocks should we trade this strategy on? We're going to also talk about the right strike price and the ideal expiration time frame. This is a very key part of this course. Make sure you pay good attention to there. By the way, since this is a very long course, I will be also separating into many different chapters so you can finish it in multiple sessions. The third part of this course is going to be about trade management. We're going to talk a little bit about theta decay in practice. We're going to talk about how to roll this trade. This is when our trade goes against us and we're wrong. We can manage it and save ourselves. We're going to talk about how to take assignment and how assignment works. Assignment means when we need to buy the shares. And last but not least, we're going to talk about a few profit-taking rules and strategies. The final part of this course will be about some extra information, advanced bonuses. We're going to talk about return on margin. We're going to talk about what you can do after you get assignment. There's a strategy called covered calls. I'm going to introduce you to that. And also, we're going to talk about some key risk considerations and risk management. So first of all, we have to go over what are options. Options are financial contracts that grant the buyer the right, but not the obligation, to buy or sell an underlying asset at a predetermined price, the strike price, and within a specific time window, in exchange for a fee called the premium. If we're buying call options, then we get the right to buy an asset at the strike price. Buyers profit when the stock rises above the strike. Put options, on the other hand, is the right to sell an asset at the strike price. Buyer profits when the stock falls below the strike price. So most retail buyers of options lose money over time. The win rate is extremely low. So buying options is a losing game. And that is exactly not what we're doing. We are on the other side. We sell options. So in our course, you already know we're selling put options. Let's talk about what are put options. Put options are used when people feel bearish on a strategy. When they long a put, it means they will hope that the underlying goes down in price. The maximum gain on a long put option is limited to the strike price minus 0. So if the strike is $50, then the max gain you can win is 50 times 100, which is $5,000. The maximum loss for a long put trade is the premium that you paid. So if you paid $1,000 to open this long put, then the maximum you can lose at expiration if the trade doesn't go in your favor is $1,000. A lot of people on Reddit, like WallStreetBets, view these as lottery tickets because it is high risk and most of the time they expire worthless. But when they win big. This is exactly the opposite of what we do. We are not buyers of puts. We do not long puts. We are sellers. We short puts and we collect premiums from the buyers that pays us. So this is a P&L chart of a short put. What we can see here is when you sell a put option, you collect the premium upfront and you take on the obligation to buy the stock at the strike price if the buyer exercises the right. Your maximum gain is limited to the amount of premiums you collect upfront. Your break-even point is your strike price minus the premium that you collected. And the potential loss of this trade is your strike price minus 0. The max loss of your trade is your strike price times 100. So if you sell a 50 put strike, then your max loss, if the underlying actually goes bankrupt and they drop all the way to 0, then your max loss would be 50 times 100, $5,000 per contract. You can notice here, if you sell a 50 put strike right here, this is 50 put, and the stock goes to the moon and goes up to $1,000, for example, the maximum you gain is still the amount of premium you collected at the beginning. So how do you win? If the stock stays above the strike price at expiration, the option expires worthless and you get to keep the entire premium. So in other words, this is a bullish to neutral strategy. I would only open a short put trade if I'm bullish on the underlying. Let's go over some live examples of how to open a short put. I have Tasty trade open here. I'm going to open the option chain for the QQQ underlying. We're going to look for the puts, which is almost always on the right side. At the money, the current market value is right here, about 723. To open a short put, all you have to do is click sell on the put option. In Tasty Trade, you can see sell has an S on it and it's red. That's all you have to do. You notice down here, this is the price you're selling this option at, and you're going to be collecting $9.75 from this trade. The multiplier is 100, so you're going to be collecting $975 in your pocket right away when you open this trade. As long as QQQ stays above $680 in 43 days, you will be able to keep this full $975 and it will be a winner. Opening short puts is that simple, but there are caveats because you have to actually want to buy the QQQ before you actually trade this, before you put on this trade. So that's it for putting on the trade. It's that simple. In the next module, I'm going to be going through how to choose the best strike in stock. The next most important thing about trading short puts is we have to be able to identify what are good stocks and what are good instruments to go long on. Stock selection is the foundation of this strategy because you only want to trade stocks that you are genuinely comfortable owning, because there's always a chance you get assigned. Now, especially if you want to get assigned, it better be a good stock and also a good strike price that you're comfortable buying at. Quality first. Stick to large cap stocks, fundamentally sound companies, or broad ETFs. Some examples would be Home Depot, Google, Facebook, or if you're into indexes, SPY, QQQ. Avoid speculative or volatile names. Try not to play any of the tickers that are popular on WallStreetBets or any IPOs or any new stocks that just hit the stock market. All the stocks or ETFs or any instrument that you're playing short puts on should be highly liquid. I will show you in a bit how you can check something that has high liquidity. The reason why we want liquid stocks and instruments is because we want tight bid-ask spreads in the option chain. Wide spread means slippage, and you'll lose money on the entry and on the exits. We want to be selling put options on instruments that has an implied volatility rank above 30. When it's above 30, it means that the premiums are elevated relatively to historical levels. So you're selling expensive options. Just like if you're an insurance company, you want to be selling expensive premiums to make more money. And when the volatility is higher, it means there's more risk in the market and you can charge a higher premium for that risk. Bullish bias is required. Again, this is a bullish strategy. You must have a bullish or at least a neutral outlook. The best scenario is the stock goes to the moon. But however, even if the stock stays flat or even slightly down trending, you can still make money as long as the instrument stays above the strike price at expiration. I'm not going to go into technical analysis in this video, but you can use your preferred technical analysis tools. You can use your RSI, your MACDs, support and resistance zones to confirm your setup and your bullish bias. Choosing the right strike price. This is key. We're going to be generally using delta to help us choose our right strike price. Delta measures the probability that an option will expire in the money. Your strike selection determines the balance between premium collected and win rate. This is a key strategic decision. Let's go over various kinds of popular strategies that people online talk about. Some people like to sell very low delta short puts because those are very high win rate deltas. But there's a caveat to it, and that is the premiums that you collect is lower. It's a very conservative approach. I personally do not sell 10 to 15 delta short puts on stocks or ETFs because the premium is just too low. It doesn't justify the risk that I'm taking on. Now, 20 delta, I believe, is a sweet spot, especially for beginners. If you don't know what to do, 20 delta is usually the measured expected move of the stock. So it is a sweet spot and a good balance between premium and risk. I would start here. What 20 delta means is there is 20% chance that the underlying will expire in the money. So it means you have an 80% win rate statistically. And 80% is a very good spot. Now for advanced traders, you can go higher than 20 delta. 25 to 30 delta is higher income, but the win rate is slightly lower. This is suitable for advanced traders once you have experience managing trades under stress and pressure. At 30 delta, again, what that means is you have a 30% chance that the option will expire in the money. So in other words, you have a 70% chance of winning, which is still very high. And if you combine this 70% mathematical edge to your trading edge, your chart reading skills, then you can really make a living out of this. I personally go between 20 to 30 based on the charts. There is a very important rule of thumb about premiums. The premium collected should be greater than 1% of the strike price for a 30 days trade. If it's not, the risk to reward is not worth it. I'll go into more details when I show you some live examples in a bit. By the way, if you guys like what you're learning so far and you want to learn more about how to make passive income every single day, click in the link below in the description for my options income playbook. Here's a real world example of using the ETF jets to identify what is a good price to sell strikes on. In this example, I marked a major support zone, which is 23.75, because there's many touches there. So right now the stock is trading at 25.50. If you feel that we are bouncing and we're bullish on this stock now, you can sell the 23 strike, for example, right below the support zone, and that will give us a buffer of $2.50. So as long as the instrument trades above $23 at expiry, we're going to collect the full premium and max gain of this trade. Oh, by the way, disclaimer, I'm not saying to go long on this instrument, and also I did not go long on this instrument. This is a random chart that I just brought up, and this is an old chart, by the way. Choosing the right expiration. This is very important. We should target to sell options that are expiring in 30 to 60 days. I usually like to choose the middle point, so 45 days hits the sweet spot. Premiums is still rich and theta decay is accelerating very quickly in this time zone. This window gives you enough time to manage the trade while maximizing your rate of decay in your favor. Choosing the options to sell puts on. I personally only sell put options on the monthly contracts. Monthly expirations, especially the ones on the third Friday of every month, carries the highest open interest and trading volume, which means tighter bid-ask spread, better fills, and easier exits. If you notice that the bid-ask spread is too wide, I would skip that trade or choose another strike. Sometimes maybe you want a 20 delta, but you notice the option volume on that strike is not good enough. It's okay to go down a little bit, maybe to 19 or 18 deltas, or even go up to 21 to 22 deltas. I also like to only trade round number strikes. For example, 705, 710. I try to avoid those 701, 702, these weird numbers, because there's less people trading those contracts. You should be avoiding weekly contracts because they have wide bid-ask spreads and that eats up profits. Again, there are exceptions. For example, QQQ or SPY, those have very tight bid-ask spreads even on the dailies. That's why zero DTEs are so popular these days. So those are an exception. So in conclusion, 45 days is the institutional standard for premium sellers. 45 to 60 days is perfect. I'm going to talk about liquidity a little bit and how you can check the liquidity of a stock. In Tasty Trade, you can go to your watch list and add something called liquidity rating under your options. Add that to your watch list and try to only trade the stocks that have 4 out of 4 stars. So QQQ is a nice one. You can see XLU is also a nice one. GDX is another nice one. A previous example of JETS, the airline ETFs, it's actually only 3 out of 4 stars. So the liquidity is not as nice. And anything below 3 stars, I would ignore. Look at this. GDXJ is 2 stars out of 4. I would not even trade it. If you really, really have to trade it, then I will only do the monthly contracts on this instrument. Now, if we look at SPY, it has 4 out of 4 stars in liquidity because this is the most popular ETF in the whole marketplace. From here, even though it is very popular, I still go for the monthly contracts only. And you can find that out by looking at the option chain. You can see all the ones with W's, those means weekly. 17 right here, that is a monthly. August 21 is a monthly. September 18th is also a monthly. We are targeting to sell options on the 45 days to expiration mark. So right here, we have a 43 days to expiration contract. Let's open that up. And we're going to look for, as a beginner, we're going to look for the 20 delta. 20 delta is right here. It is below this measuring stick. If you see this orange stick right here, this ruler, Tasty Trade auto calculates to you what is the expected move in 43 days. So using the mathematical models that Tasty Trade calculates, they expect SPY will hit 724 on the low side in 43 days. At 20 delta, we're just slightly out of that range, so that's nice. Now, I also mentioned that I don't like trading these weird numbers, 718. So although that is perfectly 20 delta, I would go up and round up to the nearest round number, which is 720. You can notice that at 720, the open interest is way higher at 31K versus 718 is at 1.1K. 1.1K is not bad, but I always prefer to sell round numbers. So in this case, I would sell the 720 strike, short put. Now the next thing I want to show you is the difference between 20 delta and 30 delta or any higher deltas. The reason why I said advanced people, you can choose to go for higher deltas is because you will notice the premium is significantly more. At 20 delta, we're getting $5.13. At 30 delta, we're getting $7.26. That's almost 50% more premiums. If you look at the win rate, the probability of profit, at 30 delta, it's 73%, which is not bad. At 20 delta, the probability of profit is at 82%. So just a 9% difference between the 20 and 30 delta, but you're getting 50% more premium. So if you're an advanced trader and you are confident that SPY will be going up and you can read the charts fairly well, you can choose to sell the 30 delta instead of 20 delta to collect almost 50% more income. while giving up only 9% of probability of profit, which is fair in my humble opinion. The next thing I want to talk about is the underlyings to do this strategy on. I personally love doing this strategy on sector ETFs because sector ETFs does not have earnings. Earning reports are binary events that can really move the market, so I try to avoid it. With ETFs, you don't have any earnings. So I always have a big list of ETFs, as you can see right here. And most of them are fairly liquid. And if they're not, just don't trade them. And for my list of stocks, I always choose highly liquid stocks to trade. Most of them are in the SPY or QQQ. That's a good place to start. Large cap stocks. I avoid any small cap stocks and anything that are not in the major indexes. I want really popular and stable big companies that are well known. For example, Meta, McDonald's, Microsoft, Netflix, Caterpillar. Those are just some examples. However, again, just to remind you, stocks do have earning reports. So if there's a E right here, you can see earnings is on August 4th in just 22 days. So I have to skip this trade because I will not open up a trade that's 45 days right here that crosses earning. What I mean by crossing earning is my expiration will be after the earning report. And during the earning report, the stock can really gap up in my favor or it can really crash down. Statistics show there is no correlation between a good earning report versus a bad earning report, whether it goes up or down. So we avoid that entirely. Let's continue. Let's talk about Theta Decay, your silent partner. This is your best friend as an option seller because you're gaining money every single day. Let me explain. Theta is the rate at which an option loses its extrinsic time value, also called premium, as it approaches its expiration date. Every single day, option bleeds value. And as the seller, that erosion is your profit. Every single day, you're making money through Theta Decay. Now, if we look at this chart, we can tell that this chart is not a linear chart. Decay is slow in the early weeks. From the 90 to 60 days to expiration, you can see right here, it is fairly flat. However, starting at 60 days right here, around here, decay is accelerated meaningfully. Decay, you can see it is the most rapid in the final 30 days. By the way, Theta works 7 days a week, including weekends, for your information. So if you take a look at this chart and we want the most amount of Theta decay as possible, it is very obvious we should target the 30 days to 60 days expiration entries. We want to position ourselves right at the start of the acceleration curve, which is right here. How Theta makes you money. As option sellers, this is how Theta works in our favor. Let's walk through a concrete example of Theta Decay generating real profits, regardless of what the stock does. Whether it goes up, down, or sideways, you're going to be making money thanks to Theta Decay. Now, when you first enter a trade, we're going to be selling a put option. Say the stock is trading at $100 right now. We're going to sell the 90 strike put with a 30 days to expiration. When we sell this, we're going to collect $100 in premium immediately in our pocket. If you divide 100 by 30 days, it is approximately $3 of decay a day. 10 days later, the options will now be worth only $70. Why? Because 10 days times $3 a day is approximately 30. So you made $30 purely from time decay, regardless of the stock going up or down or sideways. The extrinsic value will decay regardless. So we can close the trade right now, actually, after 10 days, and you can buy back the short put at $70. If you do that, you're going to lock in the $30 profit from the premium portion, extrinsic value decay. Again, the beauty of this strategy of selling puts is that the stock didn't need to move up. Theta did all the work. This is the power of being an option seller. That's why I said before, being an option seller is a downhill battle. You are making money no matter what, even during your sleep and on the weekend when the market is closed. It is a low risk and semi-low reward strategy compared to being an option buyer in that sense. Because as an option buyer, you're fighting an uphill battle. You're losing money every day thanks to theta decay, unlike an option seller. And because the option buyers take on such a risk, when they win big, and their reward is higher. Hence, buying options is high risk, high reward, and as an option seller, it is low risk and lower rewards. But I would choose to be a option seller any single day because of theta decay, and it is just that much simpler, and your win rate is extremely high. By the way, if you like what you're learning so far, you can get a full detailed PDF of how to sell options for income in the description below. Check it out. Let's go over the next module, which is trade management overview. In my opinion, this is one of the most important module, and this topic is something that most online resources do not talk about. But I'm going to go over this portion in detail so you guys can know what to do exactly in every single scenario you encounter. How you manage a trade is just as important as how you enter it. There are 3 core scenarios every put seller must know how to handle with discipline and a clear set of rules. This is very important to reference back, and you have to have this plan set in place before you put your trade on, because you don't want to be flip-flopping ideas and changing up your trading plan when the trade is going against you. The first thing we're going to be talking about is profit taking. We're going to talk about exiting early when you captured a significant portion of premium, locking in the gains and freeing up capital for the next trade. The second part we're going to talk about is taking assignment. The stock is assigned to you at the strike price. If the stock is trading below your strike price at the time of expiry, you will now own 100 shares of that stock. However, that's good because this was planned and you chose this stock intentionally, and you also chose the strike price that you want to own the stock intentionally. Rolling is a strategy that we use when the trade is going against you and you no longer want to take assignments. So we will close the current losing position and reopen a position further out in time, collecting additional credit to extend and improve the trade. I'm going to go over all these 3 scenarios in details now. Case 1. Let's talk about profit taking and exit early. The 50% rule. We're going to exit the trade when you captured 50% of the maximum premium. This is the industry standard for exiting premium sellers. It is a good balance between risk and return efficiently. So, for example, if we collected $100 in premium, we're going to buy it back at $50. And you're going to realize $50 in profit. This is the case when the stock goes up very quickly and assignment is no longer part of the plan, or it's not as realistic anymore. Or especially if the stock went up, say this is a 2 months trade, a 60-day trade, and within a week, your trade is up 50% already. There's no point and no reason to wait the other 52 days left to capture the remaining 50%. We should take off the risk and just realize the gains. Take the money and run. The 21 days to expiry rule. When we have only 21 days to expiry left, we always exit or roll your position, regardless of profit or loss. Why? The reason is because there's something called gamma risk, which spikes sharply within the 21 days. A small price can cause an outsized loss. Gamma risk is a very big topic, and I'm not going to go into too much details in this lesson. I will be making another video at another time to explain about that. But just remember, gamma risk is very serious starting at the 21 days to expiry mark. Hence, we're exiting. At 21 days, the risk to reward of holding further deteriorates. Because most of the time by days, just by theta decay alone, your premium should be already cut in half by that time. If you're not at the 50% profit or whatever percentage you plan to exit at, you're likely not going to win in this trade. Your trade is probably not going in your favor as you like. Exiting early frees up capital for fresh, high quality setups. Sometimes it's best to just close the trade as a small winner or small loss and just move your capital to a new trade, because these short puts trade does take capital to trade or it takes up your margin to trade. So you can free up your margin or cash to put on other trades. If you're deciding to take assignment and you don't want to exit at 50%, I talk about exiting at 80%. The reason is because sometimes we want to be taking assignments, so we're not closing at 50%. However, if it hits 80%, I highly recommend you to close the trade. Holding further ties up buying power for an unlikely assignment, so freeing up the capital and redeploying it makes more sense at that stage. For example, if you collected $100, you will be exiting at $20, so you will be realizing $80 in profit. Again, this scenario is when assignment is not likely anymore, so it's time to get out of this trade. It's not worth holding anymore. The stock already went up to the moon and assignment is highly unlikely. Case 2, taking assignment. This is when we want to acquire the stock. This is a stock acquisition strategy. So we talked about selecting a quality stock at a price that you're happy to own. Assignment is not a loss. It's part of the plan. You chose a strike price that you want to get assigned at, you want to buy at a discount. And this strike price is almost always below the current value of the stock. So if you're planning to take assignment, your P&L on this position will show negative and red. You'll see a minus 100%, 200%. So it looks like you're losing. But the key point is you don't do anything because you want to get assigned. If the stock drops below your price, okay, for example, your short put is 90 strike and the stock ends up at $80 on the day of expiry, stay calm. You plan to own the stock at $90, so let the trade proceed to assignment. No panic closing the trade. If you close the trade, you're going to realize a loss and you're not going to get the assignment. You're not going to buy your 100 shares. So that's going to destroy your whole trade. Just leave it on, and on the Friday, let it take assignment, and by Monday, you'll get the 100 shares in your account. This is a key mindset shift. Assignment is a feature. It's not a loser. It's not a failure. You are buying a stock you want at a price you chose with a discount equal to the premium collected, on top of the price drop that you got from when you entered the trade. Let me give you an example. Maybe Disney is trading at 120 and you chose the 90 strike to sell the put at. Now the stock is at 85. You're going to buy the stock at $90. You're saving $30 alone plus the premium you collected. So the premium could be maybe $1 or $2. So you further decrease your average entry cost. Case 3, rolling the position. So at 21 days, and if your position is losing and you don't want to take assignments because you can see the chart doesn't look good, or whatever reason you change your mind, okay, you can use a strategy called rolling. And what rolling is, it's a very powerful trade management tool when a position moves against you near expiration. It's not admitting defeat, it's extending your opportunity window while collecting more premium. So let me explain how rolling works. The first thing you have to do is you have to buy back the put option. Okay, you will realize a small loss there. The next thing is you're going to sell a new put option that's further out in time, the next monthly. And while you do that, you're going to be collecting credit. And what this does is you just resetted your clock from, say, your 21 days to expiry option. You rolled it out in time to the next monthly, which will be adding about 30 days of time for you. So your new days to expiry will be about 53 days. The golden rule of rolling is this: you have to be always collecting a net credit. If you cannot roll for credit, do not roll it. Reevaluate the whole trade entirely. Rolling for a debit usually means you're digging a deeper hole. Even when the stock is in the money and you're losing, when you roll in time, there should be enough extrinsic value in the further dated option contract so that you collect a credit. If you cannot collect a credit, it means you're probably so deep in the money that there's not much extrinsic value left in the further data option, and it means you are so in the money that this trade is probably going really, really wrong. And at that stage, it's probably best to just close it. Now, you have to look at your TAs, you have to look at your chart and do some technical analysis. But in general, the rule is if you can't collect any credit, the trade is probably very, very bad at this point. Let me go through an example of how to roll a trade further out in time. So say we have an option right here at 21 days to expiry, right here, 21 days. And say it is currently right at the money for us. The strike is 295. Right now, our position will be like this. We will have one short position on the 295 strike. What we're going to do is we're going to roll this out in time. And let me show you what I mean. I'm going to buy back this option, and then I'm going to go 30 days out to the next monthly cycle. So 21 days plus 30 days, it's about 49 days, right? That's the closest one we can get. And we're going to sell the same strike, 295, and we're going to be collecting $2.92 per contract. That's equivalent to $292 just for rolling further out in time. So from 21 days, now our option will become a 49 days to expiry 295 short put. And we're going to collect almost $300 just by that maneuver. The next thing I want to talk about and teach you guys is how to calculate the return on margin. Unlike buying stocks, selling puts doesn't require full capital outlay. You can use margin as collateral, so returns should be measured against that margin, not your full account. So let me give you a real life example. We sold the 85 put Disney 43 days to expiry contract, and we collect $1.25 in premium. The margin required to open this trade is only $993. Let's just say $1,000 for simplicity. You collect $125, so if we divide 125 by 993, that is 12.59% in just 43 days. That's a very big return. Now, if you divide 12.59 by 43 and multiply by 365, the annual return on margin is actually 107%, 107% if you could repeat this consistently. This is amazing. This is very high return. especially on margin. So because margin is so efficient and you don't require the full amount of cash to open these trades, we have to be very careful when it comes to our position sizing. Position sizing rules is a key risk management tool that you must obey. Let me go over it in detail. Never risk more than 5% of your net lick value per position. For example, if your account is 100K, the max you can open is $5,000 margin per trade. In our Disney example, you can see the margin required is 993. So you can open up to 585 short puts in your account if your account is 100,000. Another important thing to do is to diversify across multiple sectors and expirations. Across multiple sector means we do not want to be opening so many short puts that are all highly correlated to the same thing. For example, you don't want to open all your position in the tech sector, Google, Meta, AMD, Nvidia. You want to spread out your eggs in different baskets. So maybe you'll have some tech, you'll have some real estate, you'll have some banking, some energy sector, etc. And another thing is you do not want to open all your positions on the same day and for the same expiry. For example, you don't want to have 10 different positions all expiring in 43 days. Maybe some of them are expiring in 30 days, some of them are expiring in 45 days, some are in 60 days. So you can diversify across various time expirations. So if some trades go wrong and you need to roll or take assignment, that's okay because you're not taking a loss on all your positions at the same time because some still have time value, some still have 15 more days, some still have 30 more days for you to control and manage the risk. Another bonus I want to talk about is covered calls after assignment. When you're assigned the shares, don't just sit on them. Put your stock to work immediately by selling covered calls. Collect premium on the shares you already own. So how does this work? You own 100 shares. After assignment at the strike price, you're going to own the 100 shares of the stock the next Monday. Each standard option contract covers exactly 100 shares. So what we're going to do is we're going to sell a call against those shares. Select a strike price above your cost basis and sell a call. You're now obligated to sell your shares at that strike if the option is exercised by somebody. And you will get paid premium either way. In other words, this is another way to sell your stocks, but while collecting premium. When you get assigned, you're either holding it to swing it or you want to get rid of it right away. In either case, someday you're going to exit this. So what you're going to do is you're going to sell that call and collect premium as a bonus while you wait. The cover call lets you sell the stock at a predetermined price you're happy with while collecting income while you wait. It's a disciplined income generating exit strategy. I actually have a video just about cover calls. Check out my channel and you can find it there. So let me go into some details about cover calls. Let's walk through a complete trade from put assignment through covered call exit. I'm going to show you how the premium income compounds your total return. You're assigned 100 shares at your pre-selected strike of $100 per share. Okay, so your cost basis is $100 minus any premiums you already collected from the short put. So that might be $1 or $2. So your actual cost basis can be about $98. Second step is sell the call. You sell the call at 105 strike against your 100 shares and you collect $4 per share. So at 100 shares, that's $400 in premium. The stock rises to 106 at expiration. Your shares are called away at 105. So your total P&L is actually, you sold it at 105 minus $100. So you're gonna make $5 on just the shares itself. And also you collected $4 of premium. So that's $900 total profits. That's a lot. And that's a very nice strategy. It's kind of like saying, I wanna sell my shares at 105 in 30 days. But while I wait, you have to pay me $400 for me to wait 1 month. Isn't that amazing? Even if the stock have stayed flat or declined slightly below 105, then you still keep the $400 premium. This is a way to hedge your 100 shares of stock too, right? It reduces your cost base further. And also, if it doesn't go above 105, then you get to keep the shares and also you get to keep the $400. And you can repeat this strategy and sell another cover call. Risk considerations. All trades have risk. And although this strategy is so amazing and it's very high win rate and very easy, there are risks we have to consider. Selling puts is not risk-free. Understanding and respecting the downside scenario is what separates disciplined traders from those who blow up their accounts. One of the risks is the stock going to zero after assignment. If the assigned shares of a company collapse, losses can be severe. But it is actually very easy to avoid this risk. First of all, you should only be selling puts on high quality, large cap stocks or broad ETFs that you're proud to hold. Never chase yields on speculative names, such as the very volatile stocks that just IPO'd or are shared on WallStreetBets on Reddit. I highly recommend you don't play any of those and don't do short puts on them. Also, I want to mention ETFs generally never go to zero because it's a basket of very different stocks. Honestly, if an ETF goes to zero, we're probably at the end of the world anyways, and you have other risk and things to worry about at that point. So in theory, ETFs can go to zero, but in reality, ETFs do not go to zero because you need everything to go down to zero at once. And SP 500, for example, have 500 of the best companies in the world. If all 500 of those companies go to hell, then we are probably at the end of the world anyways. The second risk consideration is paper losses during the trade. Your position will show unrealized losses when the stock drops below your strike. Now, this is normal and expected. Do not panic close based on emotion. Manage your exits using the 3 different strategies that I talked about before. And you should manage your exits using technical analysis, such as support levels, resistance levels, and also you should use the 21 days to expiration threshold. And at any time you can exit early if you feel like it. You can always exit early. You're never trapped. You can buy back your short put at any time before expiration. You don't have to wait for expiration. If a stock breaks down technically and violates your thesis, if you can read the chart well and you think this is not for me anymore, I don't want to take assignments, I don't think it will go back up, there's some very bad news that came out that destroyed the whole technical analysis and thesis, then you can close the trade and preserve your capital. Flexibility is a feature of options. Use it wisely. It is similar to trading stocks. An option contract can be traded, bought, and sold anytime when the market is open. Traders, that wraps up our masterclass for short put selling. There was a lot of material and a lot to go through. I didn't expect you guys to go through this in one go. That's why I separated this class into many different sections and modules. I have added a lot of chapters in this video, so you can come back to it anytime. Save this video. And also, if you like what you learned today and you want to learn more, check out the link in the description below for my options income playbook. You can download it for free, and the link is in the description. Traders, trade small, trade safe.